We both sat listening to that, some very clear messages from the IMF to China, which is about rebalance, stimulate internal demand, and don't bank on any fast and furious rate cuts from the Fed. I think three very important messages. What matters the most to your world?
China matters because it's the second largest economy. It's not a huge holding in our portfolio, but we've got to recognize its place in the world is so critical now. And I thought the comment about the housing market was very interesting because it's been a problem for a long time. They really need to manage that properly. And the focus internally into China's domestic economy, we know from just what our general partners and our asset managers have said is dominant in the Chinese government and their focus of the party is their own economy. And it needs to be strong. It's a big chunk of the world.
Because that permeates not just to perhaps your overseas allocation, but also here to the US as well.
Well, exactly.
They've got to get it right. Big macro policy response from China seems to be something of the early 2010s, 2011s, and that's not the policy road it looks as if we're traveling.
Well, and you look at, it's amazing how many people they've taken from poverty to middle class, but now they have this gigantic middle class that wants employment, wants stability in their housing prices, and that's taxing all their efforts.
Now, when it comes to managing massive amounts of money, there's you, and then there's the Norwegian Sovereign Wealth Fund as well. And earlier today, I caught up with Trond Grande, Deputy CEO of the Norwegian Sovereign Wealth Fund, and this is what he had to say about tech.
Okay.
It has become the biggest sector of our investment portfolio, but it's also a very expensive market, or if not very expensive, it's pretty highly priced. So that's why we're being a little bit careful.
Well, from macro policy to equity allocation, it's a swift pivot. But I thought it was an interesting salutary warning about how expensive tech has become. You have your allocation to tech. How much more cautious are you becoming on that allocation? How much caution do you have around technology? All hail NVIDIA.
I'm cautious all the time. Well, and let's recognize he's what, 5, 6 times my size. So, and they own the equity market. So technology is not just in U.S. equities and just in equity. It's in our private equity portfolio. It's in our real estate portfolio. It's in our infrastructure portfolio because of the energy demand on technology. And I agree with his concern about valuations. It is priced to perfection. But we are literally, I mean, Jamie Dimon said it's equivalent to the steam engine. I'm not that old, so I don't know. But maybe the invention of the light bulb? I mean, that dramatic. The hope for AI is probably overpriced and overshooting, but it really is a dramatic change in technology that will affect all of our lives. I have no question that a year from now we'll be shocked at how many types of AI products we are using and maybe not even realize it. So I think that they're overly optimistic, but they have a reason to be optimistic.
But you would say from the macro policy point of view, perhaps we're over hoping for the productivity gains that come from AI. That is your cautionary point, isn't it?
Well, always. The markets overshoot. They're over-optimistic about especially new technology. And I worry, the difference this time is companies are making real money on these things. And giant companies are leading this effort. This is not like a .com era where we have, flyinyoursuit.com and every crazy idea. This is Amazon and Google and Microsoft and Apple leading the charge.
I would just say that Dan Ives was with me. He said it's a get out the popcorn moment for tech. It's going to flex their muscles, and we're going to look back at this mini dislocation as perhaps being one of the greatest buying opportunities. Is that a stretch too far?
Yeah, well, I would say so, but you need a market. You need somebody who's going to say that because there's also somebody like this week who's selling it. So you need both sides. Look at how far the market has come this year alone, and mostly based on that Magnificent Seven. It's overly optimistic, but that doesn't mean that it shouldn't be optimistic.
The same question for you as we had for Norges Bank, which is 70 basis points hike in rates in the 10-year bond yield. A lot of that is over the past month.
Yeah.
Is the worst of that bond ride over? Is that a moment, a Damascene moment for the bond market, that it recognizes that you're not going to get fast and furious rate cuts from the Fed? Are we done on the worst right in the bond market?
Tough to always call a top in the market. I thought Vanguard's point today that it could actually, the 10-year could back up to 5%. I was really shocked to see that line, only because the market was so optimistic at the beginning of the year with 6 rate cuts. Now we're down to 1, and the equity market has taken it in stride. So I haven't been popular, but I've been saying for over a year, you've got to take your cues from the bond market, not the stock market. And the bond market is telling you that rates are going to stay higher for longer. And with the IMF, the interesting question, a rate cut, back to where? What is the base rate? It's not 0. I think the base rate is probably higher than 3, probably 4. So, and right now the economy is doing great with rates at 5. I don't know if we need to cut.
With that in mind, again, we've seen the repercussions of higher for longer. I would say the beginning of the repercussions of higher for longer. One of those is the commodity trade. One of those is the inflation trade. How are you and the board and the investment committee looking at inflation protection moves, additional inflation protection moves within the fund?
We actually have that as an asset class because we recognize that inflation is going to be sporadic, but it is higher for the next 2 decades than it was in the prior 2 decades.
Right.
And for traders, generally in this work environment, that's a surprise to them. I've been around long enough that I know inflation can be persistent and higher. So I think investors, particularly retail investors, are going to have a hard time finding inflation-protected securities in their IRA, in their portfolio. Physical assets like real estate do okay, but we're seeing inflation jump up in different ways. And I think people need to look back at fixed income. It's an investment opportunity and it belongs in your portfolio. That nice steady income is nice to have as the markets ebb and flow. We haven't had a recession in a long time. So I think people really need to be more balanced in their portfolio. And that's what we're trying to do. Physical assets like infrastructure, as well as real estate and other opportunities. It's got to be a blend.
Again, the narrative around commercial real estate is that it's been a tough time. It's been turbulent. There's been moments of existential angst, to say the least. Would you be inclined to take opportunity if there are major drawdowns again in commercial real estate to take opportunity? Norges Bank are prepared to. So what's your view on real estate?
Well, in Norges Bank, I mean, when you look at their portfolio, they're primarily
7%.
in public markets securities, just starting to go into what I would call private market securities, real estate, private equity. At their size, that's enormous. And within real estate, you've really got to bifurcate that market. The office market, no question. That was changed because of the pandemic. That is a new existential change on what does office mean. Manhattan's packed. I get it, so office is fine here. But in the middle of the country, office is vacant oftentimes for huge parts of it. But other parts of real estate are very attractive. Warehouses, apartments are still in high demand. And now you're looking at subsegments of student housing, senior housing. For us, we're big in the biology and life sciences buildings, very specific type structures. So real estate has still a huge value. And I think U.S. investors are looking at non-U.S. and non-U.S. are looking at real estate. So some segments, office needs to come down even further. It needs to readjust to that 5% rate.
Just to square it away very quickly, with bond yields at this level, maybe even touching 5%, are you duty-bound to step in and pick up duration? Are you tempted at these levels?
Well, not just tempted, we are. We have been feathering into fixed income throughout this year. We're going to continue to. And for us, fixed income, as rates went to 0, we lowered our allocation all the way down to 11%. Now we're in the process of rebounding that back up because we found it attractive.
And do you blend that up with IG? If you're feathering the nest, as you say, then what's your proclivity to investment grade and to high yield?
Well, when you buy the Bloomberg Ag, you buy the entire part of the curve. We like sovereign debt in terms of taking the rate bets and duration bets. And what I'm seeing with ourselves and our peers is investment grade credit is attractive, but you can get a better return and some flexibility out of private credit. And since that's oftentimes variable rate, it improves your convexity and the ability to manage the curve.
Look, bonds to a certain extent over the past 48, 72 hours, at certain moments, behaved in a way which one could say was a hedge, which it was what they traditionally did in moments of real angst on Friday in regards to Iran, Israel. Do we see those hallmarks remain and indeed reassert themselves as a source of a hedge and a haven?
I think we do. As we back away and look at the whole world for opportunities, particularly in those kinds of crisis spikes. And it was interesting. I turned on Bloomberg radio on Saturday morning, and the only thing that was quoted was gold and Bitcoin, because it's the only thing that trades on the weekend. But what really mattered, those trades were minor. What really mattered was people running into 30-year U.S. bonds. That is still a safe haven. And thank goodness, because we're a debtor nation. We need to borrow a lot of money. So I think that the bond market and the U.S. bond market is still an anchor to say for global investors. It will continue to be. And I think it needs to be part of everybody's portfolio. So many investors are just focused on tech and on public equity. They really need to balance it out with fixed income in their portfolio. And it's got a return, a positive return with a nice steady yield. That's worthwhile grabbing.